I'll tell you the answer right up front. It's called the 5% deferral rule. That's how we can legally avoid a portion of our income taxes here in the UK using insurance policies as an investment. Hey friends, welcome back to the channel. This is part 2 of a series of videos dedicated to financial planning for those moving overseas, specifically to the UK. Part 1 looked at inheritance taxes, and we'll link that in the description below. But basically all these concepts can be used in most Commonwealth countries, as all their tax codes are very, very similar. In this video, specifically, we're going to have a look at this 5% deferral rule. We're also going to give you a case study of an insurance policy illustrating this and what it might look like. With taxes, basically when you immigrate to a country, a snapshot of your net worth is taken the day you land. Most people sell up and cash up, and they bring all their money into that new country. But actually, this might not be the smartest thing to do, because there are significant tax implications if you do that. If we have a look at estate taxes around the world, the UK is actually very high at 40%, which is their maximum bracket. Similarly, with income taxes, it's also very high at 45% being their top bracket. So if we can minimize these, that's actually a very smart thing to do. We're also seeing the trend that people might not be making the same money as their high-paying job in the new country. So why not supplement their income with an investment policy, for example, left in Hong Kong? Something to think about. According to our tax advisor, there's actually several benefits of using insurance policies to mitigate taxes, especially if these policies are overseas. Tax in the UK for insurance policies are considered whenever there are two events that happen. These are called chargeable events, and that is when an insurance policy is surrendered or when there are withdrawals from an insurance policy. Specifically with surrender, there are two cases when this happens. One is simply a surrender or a cancellation of the policy, and number two is when there is a death of the insured. The policy is canceled as per the specific clauses. So both of these events trigger the surrender. So an insurance policy normally has three parties. The policy owner, who is the person or company who has purchased this insurance policy. The insured person is the specific person who, if he or she passes away, triggers the death benefit or the sum insured to be paid out. And the beneficiaries, where this money is going to in the case of the insured person passing away. And the key thing to know is that if the policy owner is the same as the insured person and the policy owner passes away, inheritance tax applies, which in the UK is maximum 40%. If the policy owner is different to the insured person, then income tax applies. And in the UK, once again, that is 45% maximum. So with withdrawals, they're basically money that you take from your policy, provided the policy is still in force, i.e. not surrendered. This amount is actually subject to income tax, but there are two key points you need to know. And number one is it's only applicable to the excess growth that you have on your investment from your premium. So let's say you've invested $1 million. Well, after growth over a few years, only the growth is subject to income taxes. Not only that, number two is basically you have a 5% allowance or a 5% tax allowance which you can defer and not pay taxes on until the end of this policy. And that could be years, away, because policies these days go up to age 138, for example. Or you can even pass the policy down to your loved ones, and as long as the policy is in force and it never triggers when it ends, this tax does not trigger. So that's one of the many benefits of actually using proper insurance policies as a tool for our tax planning to minimize that tax. And let's have a look at an example of how this works. So here's a case study of a person who is age 41, and he or she has $1 million US to invest, and he or she has invested this $1 million in this insurance policy where the insurance company then grows that $1 million. So if we have a look at this sales illustration, basically there's the premiums paid, There's a guaranteed cash value and a non-guaranteed cash value with sort of dividends and bonuses. The sum of that guaranteed and non-guaranteed is basically going to be the account value, or what we call the surrender benefit. And then there's also a death benefit. In this case, the death benefit is only about 5%, being $50,000 of $1 million. But that grows as the account value grows. So if we have a look at this death benefit versus others, there's products where the death benefit is about 300% of the premiums paid. So it really depends, and we can actually get quite creative here. For the surrender benefit, in this case, it breaks even in 4 years. So remember your premiums paid, that's $1 million. And the taxes in terms of income that you withdraw is everything above that $1 million. So for example, if we have a look at the 10th year, and if we go over and we have a look at the surrender benefit, basically it's 1.483. In this case, $483,000 would be subject to income taxes if you take that all in one go that year, because that is above the 1 million that you've put in. Okay, so that's how that works. And now let's say the person wants to take 5% or $50,000 each year from the age of, let's say, 55 to 85. This amount, that 5%, is what we call the 5% allowance, or the deferred amount. That amount is deferred in terms of the taxes till the end of the policy. So you don't pay taxes on this income until when this policy finishes. Now this policy, or most policies these days, actually go up to age 138. And you can actually transfer the ownership to your beneficiary or some other person within your family, for example, and that person can enjoy it up to 138 years old as well. So basically, the tax just gets pushed down the road, if you will, and you don't have to pay income taxes legally. So towards the end of one's life, you can also have a look at this and as a reserve. And basically, let's say at age 85, there's a significant reserve here of 3.14 million. Call that the death benefit. And if you pass away, this can efficiently pay for inheritance taxes, or pay for inheritance taxes that are triggered from your various assets that you want to pass down to your loved ones. So that hopefully gives you a feel of this kind of product and how these insurance policies can help mitigate the income and also the inheritance taxes. So talk to your tax advisor and financial consultant, because these things take time to set up. But once set up, there are significant advantages. I think the key is to know that there are parts of the tax code that can be used to minimize tax and to delay tax payments. I think insurance has a vital role to play in one's financial plan for this purpose. So I hope you found this video useful on how to minimize income taxes in the UK. If you want to check out our video on minimizing inheritance taxes, please click the link at the end of this video. Thank you very much for watching, and I'll see you in the next one.